Good day, everybody. Once again, I welcome you to the webinar. Recently, I had a chat with some of you and decided that before we move on to market profile concepts, I think I need to elaborate on practical applications of supply and demand. In my previous webinars, I was pointing out how to find levels, what to look out for on longer-term charts, and how to pick better zones. But today I'm going to show you some techniques on using supply and demand to do intraday trades, or at least how to find trades that can resolve themselves within a day or possibly 2 to 3 days maximum. I've had some of the traders say that after going through my webinars, they're able to grasp the concept of longer-term trends, and they can find and successfully trade levels on daily and weekly charts, but usually that their setups take like 2 weeks to come in, which is a little bit too long, especially if you're learning. So in order to address this issue, without further ado, let's delve into the subject matter. So the first difference to do when you're looking at your charts is to open up a lower time frame. I myself generally like to trade from 30 minutes charts and 15-minute charts for that. Reason being is that these two time frames offer levels that basically require much smaller stops for the most part. And if your chosen instrument has any kind of normal liquidity, you should be able to spot some areas of interest, fairly frequently, like probably about 2 to 3 times, maybe 5 times a week. Now, I wouldn't recommend going all the way down to 5 minutes because generally there's still quite a lot of noise there. And while there is a way to trade that, you would still need to have a very solid understanding of how lower time frames interact with higher time frames. So for now, for this first technique of supply and demand intraday trading, let's stick to 30 minutes and 15 minutes. The next thing to do when you're looking at your chart is to look for areas of consolidation. That's an area where prices didn't move much. Usually these areas look kind of like boxes, like rectangles and boxes of candles. And the way to locate these is to look for large moves and then look to the left of the large move to check to see if there was some consolidation before the move. And the reason for that is because larger moves are generally easier to see, especially when you're first starting to use supply and demand. And I know that a lot of you might already even be able to spot consolidations because now you know what you're looking for, and eventually it becomes second nature. But to start with, look for large moves. It's just much easier. Once you find your consolidation, I recommend checking whether the consolidation happened inside active trading hours. So for example, if you're looking at euro-dollar, trading hours start with Frankfurt open and finish at Wall Street close. So in London time, that's 7 a.m. to 9 p.m. because that's the time euro-dollar trades throughout the overlap of the two biggest exchanges in the world, London and New York. And now that's a window of about 14 hours. So you can either sit there kind of in real time looking at it, but generally the easier way to see it is through volume. And I'm going to show you what I mean by that. Let me just get a chart out. Okay, so basically, in your MetaTraders, if you right-click on the chart and you go down to this area called volumes, you click it, you will get like a basic sort of volume information there. Now, I never use volume for entries. I don't really find it that useful. However, where I do find it useful is to see whether something, whether like a consolidation happened inside trading hours or outside trading hours. And for example, just by looking at this, I can see that there's this area that doesn't have a lot of volume, and I will guess that these areas are outside of trading hours. And if we check that, let's put a line, and you will see that in fact it is 2:30 in the morning, so it is outside of trading hours. And then as soon as the volume starts picking up here, that's already basically Frankfurt open, and then London, and so on and so on. So this is how I find volume quite useful. Okay, so once you, so going back to consolidations, once you spot your consolidation, and let me just get rid of this. So once you spot your consolidation, really at the time of trading, and seeing a consolidation, all you will probably see is something like this, right? So we've had a trading day. I happen to know that this was a Draghi speech. He made some kind of an announcement. This is like, today is the 7th of September. So this is from last Thursday. So we had basically a Draghi speech where they basically kept the rates untouched, and then nothing much happened. And then the next day we had the NFP. So at about 4 o'clock on the day that Draghi was talking, we basically started getting this consolidation here, and that's all you can see at this point, right? And then at this point you're still not doing anything. You're not, like, I'm always trying to say, never guess where the price will go, just see what's already on the chart, and this is how you do it. So we have a little consolidating area here, so we had one candle, didn't go anywhere, and from this whole thing I can already see that this formation is a potential drop base formation. But I don't have the full picture yet. I still don't know whether this is going to be a drop base drop to continue the downtrend, that's more than obvious here, or whether we might have a drop base rally and basically a turn in the market. So now you got your consolidation. Now you watch. All you do is watch where the price starts to go. So if I start scrolling through the chart, we can see that the price is headed upwards. Okay, so now you can make an educated guess that it's quite likely that you want, if this continues to go up, you will basically wait until the strength of the move away reaches at least kind of 3 times risk reward of your necessary stop. What do I mean by that? Let's draw some lines. So let's say that that's a bit much. Let's say that this is your level that you're looking at. And so basically now I have the level with a certain number of stop ticks. And now I need to determine how much I want the price to move away before I will consider this level as a valid demand zone. For me, especially for intraday, it's minimum 3 times risk reward. So before I do anything, I want the price to move away to hit the 3 times risk reward, and then I will decide what I'm going to do, whether, depending on how strong the zone is, I will decide whether it will be a limit order or whether it will be a confirmation trade. So how do we figure out the 3 times risk reward? Again, this is some basic maths here, and you can do it like manually. For long orders, because here I have a demand, you would basically type in your entry price, you would subtract that from your stop price, and then you get your number of risk ticks, how many pips you need to use or you want to use in order to get into this level. For this level, it's 25 ticks. Now, I don't generally go 1.11080 minus 1.110. Like, that's just like a waste of time, right? I'm only taking the fourth up to the fourth decimal point, and I'm disregarding this whole number because we're going to be in 1.1 territory for, you know, quite a long time. So, you know, you just disregard that and you go 1108. Fourth decimal point is your pip number. So if you look at the number 11080, the fifth decimal point is a point, not a pip. So you need a fourth decimal point. Therefore, you don't even have to use the last point. And likewise, your stop is at 1083, so not 10830, but just you take the fourth decimal points and makes 25 ticks. Okay, in order to get your risk reward, let's say you want 3 times risk reward, you need to multiply the number of your stop pips by 3 to get the 3 times risk reward. If you want 4, you will be multiplying it by 4. If you want 5, you will be multiplying this number by 5. So now we get a number of 75. So that's the amount of move that we need to see from the entry price to get 3 times risk reward. So you will add this number onto your entry price and you will get your 3 times risk reward point. And I will mark it on the chart. There we go. So that next line now represents a 3 times risk reward. Okay. For sell orders, again, slightly different. Usually your stop price, well, your stop price is always above your entry price for short orders, correct? So therefore you need to subtract the stop price from entry price, multiply that by 3, and then take that away from the entry price. In other ways, here we go, that's the equations, how to calculate risk reward from entry price. Now what I do for short orders, if I do want to do this manually, I take the stop price minus the entry price times 3, and then I just subtract that from entry price, and I will get a negative number. But I just disregard the negative number and treat it as positive. If you want to be kind of quite mathematically pedantic for shorts, you would have a slightly longer equation. Although if you're into maths, you probably don't need any of this, but here it is anyways. So stop price minus entry price times 3 will give you an X number, one unknown, whatever it is. It's not an unknown, it's a number. And then you will take this X and you will subtract that from the entry price to get your 3 times risk reward point. So all this is very well, but honestly, while I can do these calculations, and I have done them for a very long time, after about 5 years, I've gotten a bit tired of doing this. And for some of the people that know me, they know that while I do enjoy numbers, I'm a little bit weird where I don't particularly enjoy calculations and equations. And I will do everything I possibly can to avoid them. So, what I like to do is I like to do something much easier. I will take I have a modified Fibonacci tool here. Okay, so you will take a fib tool, you will drag it from your entry price to your stop price. Let me just get the entry right. Okay, so, and this will pretty much give you exactly the numbers that you need in like one drag on the chart. So to explain this blue indicator more, it is a modified fib tool. It's quite handy to have when you're, I mean, I deal with multiple instruments. So if you want to quickly determine how far you want something to go and you've noticed the consolidation, I'll just drag that out, put it on the chart, drag it on, and I have all of my levels, like in, 5 seconds flat or less. If you guys want to make use of this, it's really quite easy to do, right? So you need to take your normal Fibonacci tool on the MT4. You need to go into your Fib properties by clicking on your Fibonacci, right-clicking on your Fibonacci even, and then go into Fibo levels, and you need to delete all the levels that are there, and then you input the new values, and I shall give you these values here. So level 0 will be your stop, level 1 will be your entry, level 3 represents 2 times risk reward, level 4 represents 3 times risk reward, and so on and so on. Now this column here, it's basically for displaying the price on the line. Like if you see my chart, see some of them have the price, but then 2.5 and 2 don't. But the entry and stop do. So for me, because I do trade futures as well, and with futures you have the daily settlement, and the reason why I have the 2.5 and 2 risk reward is because sometimes you're in a trade and you just running out of time. Like you have to close it by like the end of the day, and if you don't, then you're breaking the rules. So I like to have the 2.5 and 2 times risk reward, just in case that I run out of time and yet I'm lingering around those 2 levels, so I will take them off. But for you, I think 3, 4, and 5 risk reward should be the minimum. Like if you don't have to do the daily settlement, then this is just, you don't really need the 2 and 2.5 at all. Okay, so back to the technique of trading. So to clarify, when I spot a brand new consolidation, now this consolidation here has no other bigger levels around it. It's an original consolidation on the M30 chart. So once again, I do not try and guess where the price might go. And I'm not going to put an order right away. Okay, that's not strictly true, because on occasion, in very strong trends, I might put an order in because you have something like crude oil, which is frequently when it goes on a trend is like just like a steam train. It just keeps going. So you can use the consolidations to kind of jump in on the levels, especially if you're using market profile and value area, or you have some kind of a different different reference point there. But generally, let's say just for the sake of education and the way you should trade, the proper way to trade, the technique that I find most successful for all of the instruments and for the day trading is, rather than guessing where the price will go and if it's going to turn from the consolidating point, I wait until the move away happens. So for intraday, that's 3 times risk reward. Once the price hits that line, I can then go back and score the level to see if the level is has a score high enough in regards to all of my conditions and all of the boxes that I need to have my kind of trade. And the scoring level again, I mean, there's a lot of people who tell me that Online Trading Academy has a scoring system as well, and I suppose, you know, once you start dealing with supply and demand, because you have all of these conditions, it's kind of a logical point to get to. So my scoring system is basically just to see how far, you know, whether we have the risk reward, whether the move away was really strong, whether it was gradual, whether it does have a base or a consolidation. Like it's sort of like 8 different things that need to line up. And once I have that score, I will then make a quick decision on whether to put a limit order if the score is high enough, or whether to just wait for a confirmation trade. And I will get to explaining confirmation entries too, but perhaps I should do another webinar dedicated exclusively to just trading confirmation entries, because there's quite a lot of stuff to cover there. But for now, let's just recap once again how I treat the newly formed consolidating areas that are not dipping into any old levels. Spotted consolidation during active trading hours. So I might get up in the morning, I'll have a look around to see if anything is creating the consolidation or box. After I spot it, I will first watch the price to see in which direction it's moving. So generally, if you do have an idea of where the direction will be, that's awesome, but things are much easier if you just watch where the price ends up and just trade the chart. So in euro dollar, the chart that we were looking at earlier, clearly, so once you had the consolidation, price started moving upwards, right? Now I also want to say, a lot of the time, you will see consolidations happen and the price attempts to move in a certain direction. It doesn't really go anywhere and ends up going all the way back down and smashing through the newly formed level. And that's fine, because that means that the price never actually reached your risk reward level that's high enough for like me to desire to enter the trade. And basically those kind of levels, I deem them as not even worth trading. I can be a little bit lazy sometimes, where I like to make as less trades for as much cash as possible. So I mean, you will see me in a trade for like hours on end, and a lot of the times, you know, it might turn on me, but a lot of the times I do get my level, and I do get my high risk reward, which kind of generally keeps me out of trouble. And to be honest, I would rather make a 5-to-1 risk reward trade than kind of sit through several 2-to-1 trades. It's just really not worth my time. If you want to torture me, you would probably put me in front of a screen where I have like my accuracy that I have now, which is around 50%, so half of the times I am correct. Basically, I will be, you know, in 2-to-1 trades, you need to understand that unless you have like an accuracy of like 80%, 85%, 2-to-1 trades are very torturous, because you will win one and then you will lose the next one. And then you will win one, lose the next one. It's awful. And me, I would rather be playing Elder Scrolls Online than suffering through 2-to-1 trades. So in this chart, obviously, to go back to our euro dollar here, it started to move upwards. I took my fib tool, I dragged it, I got my 3 times risk reward points, 4 times, 5 times. As soon as the price hits 3-to-1 risk reward, for me, that's the first clue that I need to place an order at the conterminus point. Now, if the price keeps moving away, to give an even bigger risk reward, I will go back to the limit order and I will modify it to reflect a bigger take profit price. So for intraday supply demand levels, you do have to spend some time monitoring the price, just because you don't know where the consolidation will happen. But don't rush it, because when you're working from M30 and M15 charts, the 30 minutes and 15 minutes, you really have about an hour to maybe 2 to 3 hours before anything significant will happen. And trading, I keep saying, when done correctly, is, well, should be a Zen process. Again, easier said than done. And, you know, I myself, I'm quite impulsive and passionate, and I tend to get emotional sometimes as well, and I get caught up in the moment and in the adrenaline and everything. But generally, if I start getting like that, you know, getting impulsive and passionate with the markets and with the price, I can pretty much tell I'm in for a bad day. Yeah, so again, to recap, and I keep repeating it, I'm just going to keep repeating it until everybody gets it. So entry technique, you spot a consolidation during active trading hours. You watch the price direction. When you see price moving away from consolidation, you draw the modified Fib tool to get your risk reward points. Wait for the price to hit at least 3 times risk reward line before you decide to put a limit order. If price moves away even further, for a 4 to 5 risk reward, adjust your take profit price on your limit order. And at this point, I want to stress the importance of finding the consolidations, right? When you're trading lower levels, it's really important to find them. You cannot trade from levels that are, you know, almost pivotal levels, which means that they have like one candle and they start moving away. That's not a valid level. That's just somebody taking profits, right? That's what usually that kind of price action means. Consolidation areas or bases represent agreement in price by market participants. Okay, very, very important. Generally, you can also sometimes find these on higher time frames too, but they are rare. And when you do find them, especially on like 4 hours or dailies, those levels are very special. They have an extremely high rate of accuracy, but the only problem with those levels is that from higher time frames, like when you're looking for consolidations and you find one and you want to trade it, if you want to trade it from a higher time frame, you're going to have to use quite a large stop, which generally means either a very small position size, or you would have to be very well capitalized. Your account size would need to be quite big. But more frequently, you will see a large move away, and on larger time frames, you will see the formations that we know, like normal formation, rally-based drop, drop-based drop. But then you would examine those levels, even if they don't have a base on larger time frames, because you want to see what went on intraday. So let's say you spot a 4-hour demand and you check to see whether, you know, you go all the way into M30 and you check to see whether there was a consolidation on M30 or M15 inside that 4-hour chart, 4-hour zone during the active trading hours again. And that can actually give you a big clue as to whether the level will work. This is exactly the same with newly formed original supply and demand areas on lower time frames. Finding those bases and boxes, they're really important price action indicator that, you know, that it basically tells you that for some reason all market participants agreed on the price. And let's say you're kind of watching your charts, you see the base during active trading hours, and it starts to consolidate for like 4 30-minute candles. That's like 2 hours, right? So you want to keep watching that, what happens after that, because it's so important for like your future levels. Wherever the price moves away from there, chances are once the price returns to test the consolidation level for the first time, same thing will happen again. And you don't really need to know the reason behind why something moved away. Because if everything else lines up and there was no new information that has been fed through the market, that particular level of consolidation will still attract a lot of attention. Okay? And again, let's recap again. Once more, everyone. We look for bases and consolidations on M30 and M15, which represents true supply and demand. Again, I wrote a blog about this a while ago, and you can find it on my main website in the blog section. You don't need a password for that. It's an open page for everyone. So you look for bases and consolidations on lower time frames. You watch the price for direction of move away. Then you draw a modified Fib tool with your risk reward points. When price hits 3 times risk reward point, set a limit order at conterminous point of SD zone. And then you watch the price for further price movement, and if it goes further than 3 times risk reward, adjust your take profit accordingly. Okay, so I generally like to take my swing trades anywhere between 3 and 5 times risk reward. So if I'm running something overnight, this will depend on instrument to instrument basis, but generally 4 times risk reward is quite good. And then if you can push it to 6 and 7, all the better. Like things like DAX, crude oil, they frequently do go to like mad risk reward points. Okay, well, that's it for me this time. Once again, fairly short and sweet. So remember to stay one step ahead of the market. Happy trading, guys and gals.